This video segment is a small part of what the market guys offer through their educational products and services. If you are interested in any of our trade alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.
Well, good evening, everyone. It is exactly 8 p.m. Eastern Time, and I'd like to welcome all of you to our monthly open house Q&A. For those of you who are joining us for the very first time, please know that the Q&A schedule follows the option calendar. And whether or not you're an option trader, you should know that the third Friday of every month is the last day that you can trade options in the open exchange. Remember that, the third Friday of every month. It's the Monday, I don't want to confuse things here, just making sure you know, it's the Monday after options expiration that we have this session. And it not only helps the option traders, but it also helps those who trade equities, because for the longest time, I mean, we're talking almost 35 years now, I've been tracking options, and the option expiration day does have an effect on the overall markets. And again, another reason why you need to mark your calendar, because historically, if you look at this, it's pretty amazing. Historically, it's the week after options expiration that we get the most volatility. So the week after expiration is high volatility. That also translates as a good thing for traders who are looking for trade candidates and trading opportunities. And this really helps with knowing how to time the markets. Last week, I actually held off on the alert for the equity traders, because last Friday was options expiration, and I was looking for the pivot point for a Monday trade for the equity traders. So I just changed it up a little bit. So this week I will definitely put out another trade alert by the end of the week for the equity traders. I might even put in a third trade alert this week for the equity traders, again, to drive my point home with regard to what happens the week after expiration. Now, this is a chart of the power shares, QQQ. And again, we record everything at the Market Guys, not just the trade alerts, but the weekly market reports. We also record the Q&A open house, so that everything that comes out of my mouth, everything that I put out to the general public, is recorded, it's archived, so that if there's ever a question about what I've said, or if anyone even wants to challenge me on our track record for percentage of accuracy, we have a hard record of everything that's been said, forecasted, put out, published, whatever. And it's absolutely amazing how accurate things have been over the past 3 years, more than anything. This year, we are tracking a 90%, I'll make it exact, it's 89.96% accuracy. I rounded up to 90%. Almost 90% percentage of accuracy for forecasting the markets. And I just put a message out to the MTA, the Market Technicians Association, letting them know of my track record, because I want to challenge those out there who are forecasting and predicting the market to see if there's anyone else out there that has better than 90%. And you know what? I'm not this, big heavy New York Wall Street guy who, has a chip on his shoulder. I could care less if someone's beaten my 90% record. In fact, on the contrary, I would love to get to know that person. And I mentioned this in the weekly market report, that imagine if you can find another person, or two or three or five people that are tracking a 90% plus percentage of accuracy in forecasting, and all these people come together in a group that group becomes unstoppable. I mean, no one, when you get the collective efforts of people who know how to read these charts together, that just increases the probability of being right. And this is the reason why I am on such a mission to teach anyone who's willing, really, to teach anyone who's willing to learn these signals, because if we can all become accurate, and maybe let's say you're starting off and your percentage is only 60%. I have no question in my mind that if you just read our book, after just reading the book, you should get that from 60 to 70, maybe 75. And then as you polish your skills for reading the signals, the percentages obviously become more improved because your skills are being sharpened. And when last week, you can see my cursor here, this was Friday. This green candle was Friday. I draw, excuse me, my English isn't as good as my forecast. I drew this line right here last Friday, forecasting what I thought would happen this week. And let me zoom in a little bit here for you so you can see. And I don't want to take too much time analyzing the markets because I really want to get to analyzing your stocks. But again, last Friday I said there's a good chance we would go up. Look at today's price action alone. Now, by the end of the week, I think prices will actually follow that line, and I'll explain why in a moment. But look at today alone. Remember, last Friday, this red candle was not there. And today, the low, let me see if I could zoom in even more. Look at the low. I mean, we're a half a penny away. Today's low was a half a penny away from the line that I drew, leaving us with a higher low today from Friday. Even though it's a red candle, don't worry about that right now. We have a higher low and a higher high. And if you look at the definition of an upward trend, that is it. Higher highs followed by higher lows, or higher lows followed by higher highs, doesn't matter, is what constitutes an upward trend. Now, during the course of the week, is it possible that we can go down a little bit and then on Wednesday go up a little bit? Sure, that could happen. Never does the market follow a straight line anywhere, but this is the general, we'll call that the speed line. That speed line represents the angle, the momentum, and more or less the price action of the market. Now let's get to why I drew that angle the way I did. Let's see. Who has been paying attention to the weekly market reports? And tell me, here we go down to the Q&A box. Who can tell me why I drew that line, and maybe what part of the chart did I draw from in order to duplicate that line? What did I do, or what did I look at? Okay, Joe says it's based on the last rise. And Joe, you're spot on. You're the first one to answer. Phil came in and said parallel line to the last upward move. Well, Phil, you're right too. Dylan said past up legs. You all have the right answer. You just reworded it differently. But that's exactly what's happened. Now let me do this. Any lines that I draw in this chart, by the way, I will have to erase after this, because if you're following the weekly market reports and any of the trade alerts that go out, I leave the lines in place so we can show the evidence of how accurate the charts are. All right, so all of you, John, Joe, Phil, excuse me, Dylan, I looked. Now, I don't have to go from a low to a high. That's when you're drawing Fibonacci numbers. I basically take it's almost like I'm drawing a moving average between the price action, between the candles, kind of like that. And you'll notice that this angle is identical to this angle. Now, when I'm drawing the lines, most often I don't draw that first and then try to move it over. I just look at it. My mind draws the line ahead of time. And then what I do is I just duplicate it when the signal is right. Now here's another one. I could go back here and I could say, okay, let's try to find that. There you go. same type of an angle as we saw here and now here. And so the market has a tendency to go ahead and go up at these angles because money is moving. And you can see that on the downward moves, especially when we go back, you'll see that the downward angles are also ones that you can duplicate here. Why isn't that going? There we go. You can see I could draw my line from there to there. I'm just going to extend so you can see the angles from there to there, right? From here, even this high, down to that low. I could do that. And you can see, look at the angles. If I had a protractor here, I can tell you that they're all pretty much within 1 or 2 degrees of one another, pretty identical in the angle that the prices are moving. Now that you know that, you should also think of, okay, well, what if I, the trader that's learning from the market guys, what if I draw my line and then all of a sudden the price moves dramatically away from what I drew? Well, that happens once in a while, and if that happens and you've based the trade on that angle or on that forecasted trend and it's not working out, then boom, bells and whistles should be going off in your mind. Trade alert, trade alert, trade alert. Exit, exit. Find the escape hatch, and that's what happens. And here's the case in point. Target was a trade alert that I put out last week for the equity traders. And look, this is the example I'm using right here. I drew this as what my forecasted bounce would be. Why? Because I looked back at these angles back here and this angle back here. And I just did that thinking, okay, the market's going to gap up. And, oh, by the way, Jim Cramer came out and made a buy recommendation on targets. Oh, I guess it's good for Jim, good for AJ and the crowd. Well, I wasn't really listening to Jim Cramer. I was reading the signals, looking at this as a role reversal. Well, didn't take long for the stock to gap down. We did get stopped out. Okay, there's the 10% of the time where we're not correct. We did get stopped out. And if you were in this trade, you should not have lost more than 1% of your account. Obviously, the stock dropped more than 1% in price value, but the way we trade using the 1% rule, if you're wrong and you're using that rule, you should not have suffered more than a 1% loss. Okay, now let's look at this. Now I could erase all my lines now that I've shown you what we're seeing here. And I would say there might be a time for us to get back into target. I'm not going to say today is the day. I'm just telling you there might be a time. And how do I know that? Because look at the weekly chart. We are at, once again, a role reversal point. Look at that. See? I had to go to the weekly chart to find that. Former resistance. And by the way, I have a video on the Market Guys site that talks about role reversal. You can go to the library if you're brand new and read about this and watch this. Here's former resistance broken. Now turns to support here, support here, support here, and maybe support here. Now, I am not going to buy target today. I may not even buy it tomorrow or even on Wednesday. I am going to wait to see what the volume does by the end of this week. And then maybe next week I'll consider buying it. Again, I'm just thinking out loud so you know how my mind works. Yes, remember, we got stopped out. The stock gapped down after we bought it. We lost a little money. But what I'm talking about here is don't be afraid to jump back into a stock as long as the signals are showing the trade is still valid with regard to the signal. Now, here's why I would consider buying back into target. Again, do not buy this if you're listening to the recording. I'm using this as an example to educate you right now. One, look at the candles now. Now that you know what the role reversal is, these are weekly candles. Red candle, red candle, red candle, red candle, red candle, red candle is 6 red candles in a row. When was the last time in 3 years, that you saw 6 red candles in a row? There's a couple of places. Here, 1, 2, 3, 4, 5, 6. Actually, it was 7 there. 1, 2, 3, 4, 5, 6, 7 there. We might have another red candle next week. We don't know. But you can see the longest stretch is 7 sequential or successive red candles in a row before the stock went up. You see? And then look at this one. When it did go up, holy mackerel, in 1 week, it stormed up. You see? So this could very well be another buying opportunity. But we have to wait for the signal. Right? So that's how we look at that. Now, the option traders will have a better time of this. If in fact this is the one that I select for the option traders, I might do for equity traders and option traders. I don't know. Again, hold off, wait for the signal, wait for the alert. But if in fact this is the trade, option traders and equity traders will be able to trade it. But it's the option traders that will actually make more money on this than anything. Again, let's go back to the indices because I don't want to get sidetracked here on individual stocks just yet. I will. Don't type in your stock symbols yet because it's already scrolling past in my Q&A box. I'll give you the signal for that. Look at what's happening in the Dow. Again, I left my lines from last week on the report right there. Here's the first day of the new week. My forecast is that we will start to go up, bounce, or pull back from the resistance, and then start to break down. Folks, this is a very serious signal right here. And I don't want my lines to confuse you, but I'm circling a particular area of the chart right here. Right here. Can anyone tell me, other than this descending triangle that I've already drawn on the chart, what other kind of pattern is popping up here? Can anyone tell me? Who wants to be daring enough? Wow, Sophie, first one to answer. Who? I'm going to see who else. Stuart, Ken, Gary, Jermaine, Marie, James, Tom. All of you have answered the same answer, head and shoulders pattern. This could very well be the left shoulder. Here is the top, or the head. Here is the right shoulder. This line right here is very, very close to the neckline. Now again, if you're not familiar with head and shoulders patterns, go to the Market Guys library on our website. There's a video that talks about head and shoulders tops. Review it, watch it. I don't care if you have to watch it 5 times. Get this in your mind, because if this goes up and retests this descending resistance area or trend line even, this could be a complex head and shoulder failure. I don't want to, again, make it too complex, but I'm telling you, a failed head and shoulder top, in other words, when a stock makes an effort to break out of a head and shoulders topping pattern and fails, that is more significant than the neckline failing on an average head and shoulder pattern. That means for 3 times already the buyers tried to get it higher. A 4th time is game over, I'm not trying anymore, I'm giving up. And then I think we could very well see a breakdown in this overall market that could be significant. And why am I saying that with such emphasis on the downside? Because we have all been conditioned to buy versus selling short. We, from as long as we can remember, have been told to buy low, sell high. And even though that's the wrong thing to do, you should be buying high to sell higher. Do not try to pick bottoms in this market. This is, I'm taking positions like a target or then we're getting out of all long positions. We're going to take bear positions in contra funds, gold, silver, and such, and we're going to start moving into those. All right, so that's the analysis of the diamonds. And if you really want to take a snapshot of this chart, go right ahead. Take a snapshot, copy it, save it, file it, whatever, and I think it'll really help you. Now, again, for those especially who are brand new to the open house session, if you have any questions along the way here, and you're listening to my live session right now, if it's live, you can type in a question. I will be asking for stock symbols in a little bit, but if you have a question about what I'm talking about right now, this is your time to interact. And you can go back and even refer back to the cues if you want as well. All right, so that's the diamonds. Let's look at the Russell 2000, which is a more broad-based index. Here's my forecast. And this is again pretty incredible, right? This was a steeper angle that I drew from the report than the diamonds and the Qs. And the reason for that is, again, past angles. Look at how steep from this low to this high. Look at this rally from here to here. Look at the steep, even for the prolonged upward trends in Russell 2000. Look at the steepness of these upward trends or up legs, and you'll now understand why I think this could go and retest this. I do not think we're going to get to a higher high. I just don't. My gut is telling me, everything that I'm seeing is telling me that we should not be putting it all into the long side, that we should be very cautious. And even though Warren Buffett has bought, what, $1 billion position into Apple, and I'll get to that too, John, I don't believe that Warren Buffett is going to change the direction of the whole market, because he's made an announcement that he's going to buy a big percentage of Apple shares. I don't believe that he's going to reverse the market. And then on the other hand, you got the other billionaire, George Soros, who's thinking, China's going to collapse any day now. And that could very well happen. And so George Soros is buying gold, and Warren Buffett is buying Apple. One of these two guys are going to be wrong in the billions of dollars category. I'm leaning more towards what George Soros is saying, and how the national debt of many countries is going to be the demise of the short-term trends here that we're seeing, or the long-term trends. I don't think the world's going to come to an end, but I certainly think we're going to in for a major correction. I mean, look at this. And again, I have to calm down sometimes, but this is a 20-year chart of the Russell 2000. We are no longer in an upward trend. We're long gone from that. Look, if I take this low and I connect it to that low, and I just project, watch. Look at this. See what I'm doing? Look at this. We've broken. I'm not going to leave that line in place because it's recorded from last week. But look at how the lows of the past 2 months have breached the trend line. There's a breach there. And when you start to see prices starting to go down and trying to maintain levels back above, that usually means the beginning of a major top. And this Russell 2000 is a major head and shoulders pattern. This is not happening over a couple of days. This head and shoulders pattern right here started in 2014. Here's the left shoulder. Here is the head. Here's the right shoulder, and we've already broken down below the neckline. This line here on the monthly chart is, again, from my weekly market report, but that is what I'm forecasting is we're going to bump our heads against that former neckline right there, and we're going to pull back. That's called, I call that, I don't want it to be morbid or anything, I call that the kiss of death. When a market breaks down below a major trend line, a neckline, a support level, we're talking major now, and it fails to get back and resume old prices over it, it is the kiss of death. I've never ever seen a market recover from a failed move back over a trend line. And then you look at this. This is the Russell 2000 on a monthly chart. If we don't go higher by the end of this month, this is a bearish engulfing pattern. A bearish engulfing pattern on a monthly chart is much more valid and significant than on a daily chart. Look at all the bearish engulfing patterns that we're looking at here at this top. Again, this is a head and shoulder. In my almost 35 years, I've never seen so many bearish engulfing patterns within a head and shoulders pattern. Here's the first one. Look, see? bearish engulfing pattern. That's 1, 2, 3, 4, right there, 5, 6. This will be the 7th bearish engulfing pattern within a head and shoulders pattern. I've never seen that, ever. So again, all the more reason why we should be looking to the downside. Again, don't be spooked by what I'm saying here. This is very, very important information, because remember, we could make money on the way down. And not only can we make money, but we can make money faster on the way down, because panic starts to come in. We got capitulation starts to move in. Then you get the news and the media start chiming in. You ever watch CNBC on an up day? They talk about all the bull, they bring out all the bulls that they could possibly find out of the pasture. And on the down days, all the bears seem to come out of the woods, right? Have you seen that? They never, or rarely, I should say, ever bring anyone on who's a contrarian to what is actually happening. And it's really a shame, because, and I was talking to John Nigerian, Dr. J from Fast Money. John is leaving that show, and he's creating his new show, and we're in discussions about being part of that program. I want to be the contrarian guy that everyone could be listening to just in case, right? Isn't that great to have a just in case plan? Okay, we could have Jim Cramer on one side talking about how to buy, all these other stocks, and then bring AJ on and say, well, just in case, they're wrong, and Jim is wrong on that stock. Here's what you might want to look at. Can it balances out? Well, you don't have to wait for these guys to do that on the networks. Do it yourself. This is what's so great about technology these days. You have all of the information that you need right in front of your computer, right there. All of the information. And also notice, I don't have a single moving average line on the chart. I don't have Fibonacci numbers. Once in a while I'll bring them up, but I don't have them on there all the time. I don't use relative strength. I don't use MACD. I don't use on balance volume. I just look at the charts and I say, you know what? Here's the price movement. Here's the spiders. Let's look at the price. Let's compare the price to the way it moved in the past, and let's measure volume against that. And then all I have to do is draw some support and resistance lines, and I'm good. And look how clean. I think I said this last month. Look at this pattern right here. It's almost identical to what we saw here. And again, almost identical to what we saw here. Look, a top followed by a lower high top. Look, a top followed by a lower high top. A top followed by a lower high. Look at this. All those lower highs started forming before the major fallouts in those markets. This was August, September. Boom, slammed. Here's January, February. Bam, slammed. If you look at the timing of all this, we're just about ready for the May, June sell-off here. We're just about there. So again, remember, you can make a lot of money on the way down. Just don't go double up and start buying into positions, especially ones that are costing you money. Do not double down. Do not dollar cost average to get out of a loss. Don't do any of those things. Clean the slate. Clear your mind. Get the stress off your shoulders. Look at the price action, and then go. Lastly, let me look at the VIX, and then we're going to get to your stocks. We're going to go a hard 30 minutes of just looking at your stocks. Hope you're enjoying this, because I certainly am. Here is my forecast from last week. Remember, this was Friday. This red candle was Friday. I said we would probably pull back in the VIX. Why did I draw that line that way? Again, look at the high from here to here. I'm just going to draw the speed line. Look, see the angle? See it right there? I took the angle here, duplicated it here, which is the same angle that I had here. Look, same angles. Look at that. And who could tell me, let me clear some of these lines up, who could tell me what price pattern this whole area is right here? Who wants to be the first one to answer that? What price pattern are we basically caught in right now? Jermaine, beautiful. That's it. Okay, James, Philip, you're all right. This is a trading channel. See, I could have even gone a little bit further back to show support, 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 followed by resistance, resistance, resistance. When you have a support line tested 3 times or a resistance line tested 3 times, that now moves from an obvious level of support and resistance to now this is a significant level of support and resistance. So this is a significant level of resistance. But when there's resistance in the VIX and the VIX is expected to go down, that is inversely related to the S&P. So again, the reason why, or one of the reasons why I think we're going to see a short-term rally this week in the S&P is because the VIX is looking bearish. If you are not yet using the VIX as a leading indicator, I would strongly recommend you put that on your watch list. Just type in VIX. Some platforms, let me see, is it Schwab or E-Trade? I can't remember. Schwab or E-Trade platforms require the $ before VIX. You just have to check. Check with your broker or vendor and you get it. But the VIX is extremely important. It is actually more sensitive to price pivot points than the actual stocks themselves. So it is truly a leading indicator. And this is one of the major reasons why our percentage of accuracy is one of the best in the world, if not the best, is because we're using the VIX in conjunction with price volume divergences to really forecast the pivot points. Okay, here we go. Ready? Put your seatbelts on. Who wants to be the first one to type in a stock symbol? Oh, Roberta. Wow, fast. Oh, Ron, you must have come in like right before I said that. You must have read my mind. All right, let's go with Roberta. And the reason I'm going with Roberta first is because Roberta put her price where she is looking, got into it. And Ron wants me to look at HTA. If you're going to put a stock symbol, and I have to tell you, because we have so many people, I am not going to take the symbols that only have a symbol. Please resubmit that and tell me what your intentions are, because that makes for a much more interesting discussion, knowing what entry point you're in, or if you're saying, okay, listen, can you look at this, this, and this? I'm looking for a buy point. I'm okay with that too. So let's go with BIDU for Roberta right now, and that's BIDU. If you don't know what that is already, BIDU, Chinese stock. It's ADR, and so Roberta, you're in this at 205. I'm guessing you bought that high. I don't know. Maybe you had it for a while. Let me give you what I think is good, and then I'm going to give you my concerns. And I say it that way because I'm an ultimate optimist. The good thing is this gap has filled. You see this one? So 80% of the time, after a gap fills, and I'm referring to this gap right here. I'm going to draw the gap lines right here. So this area right here, let me do this. Let me erase all these lines, because I'll redraw some for you. Okay. So this gap has now filled. 80% of the time, after a gap fills, the stock reverses. So that's the good news. It's gone up. The only thing, and this is why I say it's a concern, is that if you zoom in here, as the stock is going up, what's happening to the volume? See, that's my biggest concern. The volume is dropping. So what you need to do, Roberta, is you have to really come to the point where you have to make a decision, because you're already down on the stock. You have to say to yourself, all right, I'm going to draw the line in the sand, and if it drops below this point, I'm absolutely going to get out instead of trying to hold on to get back to break even. Because I'm sure many of us have already gotten in a stock that's lost money for us, and we say, you know what? All of a sudden you get really religious, and you start praying for the exit point. oh, please, God, help me get out of this one at break even, and I'll never trade again. that one, that prayer. I don't like the idea of pursuing break even, because here's why, Roberta. You're tying up a lot of money in BIDU, and instead of waiting for this stock to get all the way up to your break even point, which is way up here, I'd rather see you find another stock of similar value and make your loss back in the one that looks more positive on the chart. Does that make sense? So the good news is it's going up to fill the gap. The bad news is it's dropping and there's still a gap below the market. You see this? So BIDU right now is caught between two gaps. There's even a gap up at 190. So Roberta, there's a chance. Let me leave that line up there. There is a chance that the stock could even go up to 190. And then after it gets up to 190, there's an 80% chance it's going to do this. Kind of fall flat. You know, so now you're only down $15 at that point. And then chances are you might still hold on for the next round lower. You don't know. So that's what I would say. I'm not really that bullish on the Chinese stocks right now, especially after George Soros said China economy is going to collapse any day now, because that would certainly hurt a stock like BIDU. So be really, really careful. Another thing is, if you look at the monthly chart on this one, you have, again, a complex head and shoulders pattern forming here as well. So be really, really careful with that. Now, Ron, I'm going to go with your HTA request. So HTA, and Ron is looking to get into Healthcare Trust of America. Now, Roberta, pay close attention to this, because this might very well be the kind of stock that I'm talking about for you, and moving your money into something that looks more positive. Now, thanks to Ron Burr, I would recommend all of you take a screenshot of this and put HTA into your watch list. And here's why. I'm going to draw some lines here for you. And as I'm drawing them, please take careful notes, because this is what you're going to have to do in technical analysis if you want to be able to trade with any kind of significance. I take this low. I connect it to that low. I project out to that low. And what I'm trying to do is connect as many of these lows. Don't worry if I slide this line up. See how I'm sliding this line up to connect that low? Don't worry about whether or not I'm touching this line anymore. It's like you're taking those points and you're drawing a mean, a line through some and almost near the others. And I'm trying to get my trend line. There is your trend line. Now on the other side, what you want to do is draw a parallel line to more or less identify the trading channel. This, my friends, is a textbook trading channel. Again, don't thank me, thank Ron. So Ron is thinking for an entry. He's looking for an entry point, and I would say, Ron, there's your entry point. You got one today, and if it even comes close to staying where it was today in the morning session, the reason I think today is the pivot point is because you had a hammer pattern on Thursday, a doji on Friday, and a green candle with a long shadow underneath on higher volume. There's the pivot point. My projection on this, Ron, is up here. I think that this could easily go back up to test this high and maybe even test the upper level of the channel line. It could go up to 32.33. I would have to adjust my charts actually for that. Yeah, this could easily go up to yeah, what is it, 32? It could easily do that, I would say. Now, that's number one. Number two, healthcare is still in vogue with regard to investors. That, you know, no matter what happens, people are going to require healthcare. You got an aging population called the baby boomers. You got people who are stressed out about whether they can afford Obamacare, but whether they can afford it or not, people are going to need healthcare. Period. They're going to need it. Then they'll have to figure out a way to get it paid for. So I think this is a really, really good stock to put on your watch list. Ron, I appreciate that. Let me just do one last thing. Look at that. This is a weekly chart. So I think that this one can make a run and actually set a 3-year high on this one. I really think you can. And here's why. Look at the volume. This is a weekly chart now. Weekly, price has been dropping on the weekly, and the volume has been dropping. That tells us that the sellers are slowing. When the sellers are slowing down, that is the feeding bell for the buyers. When the sellers slow down, the buyers start moving in. And I think that's exactly what we see here. Okay, so now let's go to Paul. Welcome, Paul. Hope you're enjoying this wonderfully hot weather in Florida. Let's see. Go back to the daily chart. And by the way, folks, while I'm looking at Paul's position on SLV, I want to tell you that this is the value that, this might even sound like a commercial, but I mean this sincerely. This is the value that the market guys provide. I'm not selling you anything here. I'm educating you. Feel free to share this with anyone you like, particularly family members that you care about, because if everyone thinks, oh, it's easy to make money in the stock market, and you have your Aunt Tilly down the road thinking about putting a life savings in, Target because Kramer and AJ recommended it last week, please understand this is the value that we provide. And if you understand the simplicity behind what we do, and through repetition, practice, you will get really good at this. This is not rocket science. This is kind of like sailing, actually. I know I'm going off on a little tangent, but it's important. It's like sailing. If anyone has ever gone sailing, you have to learn how to read the wind. Otherwise, you're going to get in trouble, and you're probably going to capsize your boat. On every sailboat that I've ever sailed, there's always some sort of a wind indicator. Whether you're racing a Hobie Cat in the Great South Bay in New York, there's a little ribbon at the top of the mast, or you have a more sophisticated J-22 racing down the Hudson River. You have to know where the wind is blowing. And in this arena here, with regard to trading and investing, you have to know which way the wind is blowing. That's what trend lines are all about. And the volume here tells us the velocity of the wind. So right now, Paul wants to know, thinking about selling cash secure puts on silver, SLV. Made some money last run up. Well, Paul, guess what? And I'm going to tell you there is a bias here in my answer, because just today I bought back into a major silver position today, right around 1562. I bought at 1562, just 3 cents higher from here. And the reason I did that, Paul, was because of this. You see that? Now, again, folks, I'm going to use the analogy of sailing, reading the wind, and understanding the velocity of the wind. Right here, the wind was blowing down. Silver was dropping. The price was dropping. Now, I originally had silver, and I mentioned this last month. And when silver gapped up, I was on guard. I was excited, but I was on guard, because whenever a stock gaps up, there's an 80% chance the gap will fill. Well, then guess what happened? Silver gapped up again. And then it gapped up again. Three gaps in a row. This is exhaustion. This is a gap. This is a runaway gap, and then this is an exhaustion gap. On the when you have 3 gaps in a row, the last gap is called an exhaustion gap. I sold out of my entire silver position. Today I bought back into it. Now, follow me here, Paul especially. I still think silver could come back to fill that gap. And I know that sounds crazy, right? Sounds crazy, because you might say, well, AJ, why'd you buy into your whole silver position? Because I'm not trading silver. I'm investing in silver. This is a long-term play for me. But I could not resist the fact that we had an exhaustion gap. So I sold out of the silver position, and upon this gap filling, which was today, the gap filled, there's now an 80% chance we can see this happen, because there's another gap up here. I'm still willing, Paul, again, I'm still willing, even though I bought back into my silver position, I'm still willing to ride a big loss or a further move lower rather than missing the big move up. I hope you understand that. I'd rather not sacrifice losing the big up move, and I'm talking about, I think silver can go to $50 kind of move. I'd rather suffer a shorter term pullback in my account as not to be in cash and miss the move. So, Paul, I love the idea you're selling puts. Sounds like you did the same thing I did. And I am very comfortable with silver. Gold is not so much, it is not looking as technically, I guess you could say, as technically sound. Because look, here's a 20-year chart of silver. You see this? Look at what's happening here. You got a major role reversal down here. You have the 20-year lows are down here. We're only $6 away from the 20-year lows. See, this is why I'm okay with buying silver. Now watch this in comparison to the gold. If anyone, I don't know, someone may have already typed in gold, but look at this. This is a 20-year chart of gold. Even though we have a bullish engulfing pattern here, it's not on a 20-year low. It's not even close to the 20-year lows. And on the monthly chart, look, for gold, the volume is dropping. So again, George Soros made a big bet in gold, hence the reason why I think we popped up a little bit this week. But I think gold actually could pull back while silver could rally. I think the gold-silver ratio is still out of whack. And again, I've been trading silver for 34 somewhat years, and my gut's just telling me that this is a good entry point. So there you go, Paul. It's a long answer to a pretty short question, but I'm going to go right to who's the next one that's giving me a stock symbol and their intentions. It says here, Stuart says the Qs, DIA, and Spider have a gap below the market at about February 10th. Do you think that will be a target? Yes, I do. I do, Stuart. But I think this week, because of what we're seeing in the VIX, I think this week we'll see a little bit of a short-term pop. But ultimately, on all those markets you've mentioned, I think we will see lower. And not just a little bit lower. I think we're going to see lower in a big way. Okay, I see a lot of stock symbols coming in that I'm passing up on because I don't see intentions. All right, here, Gary typed this in twice. Gary says KASY, wanting to enter here. Now remember, Gary, what I said about the markets, okay? Be very careful about trying to jump in on a long side. Now this one, this looks pretty extreme, but this is the monthly chart. While I was on it, I might as well bring it up, right? The monthly chart is showing a bullish engulfing pattern here. That's good. All right, let's go to the weekly chart. Let's do the weekly chart. Weekly chart showing an upward trend. That's good. All right, remember, this is a weekly chart. The volume is still maintaining higher levels on the way up. That's good. The only reason that that's a low volume bar is because today's Monday. By the end of the week, we'll have to see what that volume does. Okay, Stuart, Gary, rather. All right, now let's go to the daily chart. Okay, everything so far, Gary, looks good. The only thing that would prevent me from buying this stock is that I don't see a green candle. Here is what you might want to do. You see the high here? You might want to wait for the stock to break out over that high on a green candle before you buy it. It's one of those cases where it's better to buy at a higher high than to wait for it to dip to a lower low before buying it. And here's the other thing you got to watch out for. If you do buy it, you're going to have to put your stop somewhere below this trend line. I'm going to put the X right here. That's where you will have to put your stop if you buy it. So if it goes up to 118 tomorrow and you buy it, you might want to put a stop right around 113 and give yourself a 5-point risk per share on that one so you can calculate what your 1% rule is. And if you missed that last part with the 1% rule, go to the Market Guys video page and watch the video on the 1% rule so you can understand that. Okay, Joe says SRPT. Let's go to that, SRPT. And Joe bought in at 1910. I don't like it, Joe. I mean, I hate to, bust the bubble here, but I see the first thing that pops out is the bearish engulfing pattern there today after it filled the gap. See, here's what I'm talking about. Gap has filled right at this level, so this is gap fill resistance land right there. You have a bearish engulfing pattern, and I mean, this is a significant gap. I do not know the news behind this drop here, but from the looks of it, that's not good news. And when a stock gaps a second time after such a major gap on this high volume, I don't like it. There's something in my gut that's just telling me, not just the signals here, but it's telling me you got to watch that one. If you could take $1.50 loss or $1.60 loss on that one, I would probably do that on the next red candle. If it breaks out, here's what I would do. If it breaks out tomorrow for some reason and that bearish engulfing pattern does not drive it lower, then what I would do is with every new support level, so for instance, if it breaks out over this high, this resistance ultimately will turn into support like this. So what I would do is, if it does happen to go up, I would be trailing my stop up with it. You can see from the price scale, this stock can move. Don't let this little bit of movement fool you here, because this is low as 16 and this is almost a 20. This is a 25% price move right there in share price. So that looks like a good trading stock, but again, my gut's telling me bearish engulfing pattern, watch out, because every other bearish engulfing pattern that the stock has shown, from what I could see, bearish engulfing pattern lower, bearish engulfing pattern here lower, bearish engulfing pattern here lower. So at what point are you going to suffer the loss? If it goes down, it could go all the way down here to 12 before filling the gap and then bouncing. So I think that's a better entry point. Like if you get out and it goes back down to 12 or 11.5 and you see a pivot point here, I would jump right back in there, no problem. If that was the case right now, I'd say go buy it on a green candle if that gap was filling. But it's the tide is going out right now, not coming in for you. All right. All right, let's see how much time we got. 8 minutes, so we're going to move on here. All right. Alan wants me to look at NMI. He's in at 395. NMI. Let's take a look. It's cheap stock under $5. NMI. Did I type in that in wrong? NMI. If this is a Canadian stock, I'm sorry to say this platform does not take. Oh, it's Nuveen Income Fund. Okay. All right. Is this the right one? NMI? Alan, is that right? The prices aren't matching for me right there. Let's see. I'll wait for you on that one, Alan, if you retype that in. NMI is coming up as Nuveen Muni Income Fund. And that one actually looks bullish, but I don't know if that's the same one because, okay, you want me to look? Oh, it's on the Toronto. So sorry. Yeah, that if you have a U.S. stock, that would be better. This platform is not set up for the Canadian version. Sorry about that. Okay, now George, we already talked about silver, so hopefully when I was talking to Paul Farley about that one, you picked up on that. So we're bullish on that. If you're just taking a light position, you still got to use your gaps. Even though I'm bullish, you have to bet or protect as though I'm going to be wrong on that one, because there's always a 10% chance that I could be wrong. So you got to protect yourself. All right, Philip is looking at. He had 1,000 shares of Microsoft put to him at $52.50. With a cost basis of 52. Okay, so you sold the puts for 50 cents. You got put to stock. Not so bad. I don't think that's a bad idea, because here, whether you're an option trader or not, let me answer Phil's question. Phil, if you sell the 52 calls, you can turn it into a covered call. But you have to be careful, because here it is again. Look at the candle. this is not a bearish engulfing pattern, but it's a pretty close to bearish, and the volume is going up slightly higher as the price is dropping. So if you try to sell the 52.5 calls on Microsoft, you're not going to get enough premium, 17 cents. It's not worth it. Again, what I would do, listen, if the trade doesn't work out, it's better to close it and not suffer the anxiety of trying to get back to break even. I think that, remember what I said about the Dow and the rest of the indices. I think this would be your only week to get out of that trade and even have a chance of getting out at a profit. This would be your week. Because remember, next week, I think the markets are going to turn lower after we hit the resistance highs. And that doesn't put you in a good position. I know it's not what you want to hear, but I'd rather tell you the truth and limit your loss than to have, tell you what you want to hear and be wrong. You know what I mean? It's not what we do here. We're reading the signals and telling you like it is. Okay, Rick wants to initiate a position in AVGO. Now again, remember, most of the questions that are coming up are you folks wanting to buy something. I don't like the idea right now of buying AVGO at all. I think this is what's going to happen to it right here. Boom. That's my forecast right there. And I'm going to leave that up there. If anyone wants to take a screenshot of that and see whether or not I'm right, here's why I think there's a 90% chance I'm going to be right. It has to do with this inverted hammer. It's almost a doji. In fact, it might even be a doji. This long shadow signals the sellers moving in. And if you go back and look at any other, and I say any other candle that has a long shadow above it, and I'm saying any candle, go back and look at any candle, what's happened after those candles was downward moves. See, long shadow, down. These are all long shadows, down. Look, long shadow on top, down. Let's see. Long shadows here, see them? Down. On the opposite side, any shadows that fall underneath the candle resulted in upward moves. Folks, I've said this many times. I'll say it again. I know people that just trade the shadows. That's all they do. When they see stocks that have long shadows above the candle, they sell it. When they see stocks that have long shadows below the candle, they buy it. And then they put the stops right below the shadows and they're done. And they make a lot of money doing that. Look, go back. Here's a long shadow underneath. Let me show you what I mean by that. A bullish engulfing panel, long shadow underneath, you buy it on that day. The very next day, oh no, it went down, it went down. Well, that's okay. Your stop is down here. You see? The next time a shadow shows up, even a small one, you raise your stop from here to here. You keep then you trail your stop. When the volume starts dropping on the way up, you move your stop closer and closer to the low of each day. And I know a lot of people just make money doing that. So again, if you want to take your screenshot, yeah, okay, sorry. If you want to take a screenshot, why? All right, here's the test question to all of you. Why am I ending the line here? Can anyone tell me? We already know why I'm drawing the angle that way, but why am I ending it there? Can anyone tell me? Let's see. Gap. Oh, you all got it. Wow, thank you, Sophie. Lloyd, Alan. Yeah, that's the area where the gap will be filled. And plus, that's an area of role reversal right there. See that? That's where I think the stock could go. Boom, right there. So, all right, I think I have time for one more. Hold on. One more. You know, I'm sure many of you would love to have this as a 3-hour session instead of a 1 hour, but let me see who. John. Oh, yeah, I told John I would look at Apple. Oh, so sorry, John. AEPL. We're going to end with John here. All right. Warren Buffett decides to buy Apple. Stock goes up. Only, what? 50 cents. Way to go. Warren Buffett. Everyone following Warren. Apple could very well go up. Again, I don't understand the logic on why Warren Buffett is buying so much of it. Because I went to an Apple store today to get a new battery and they couldn't help me. Seriously. So, not that I'm against Apple for that reason. But Apple has gapped. See, I wish it didn't gap up today. But here we go. You got a long shadow above the candle today. Ultimately, I think this gap could fill, and I do think this gap could fill. It might take a long time. I do think Apple could do that. And it could go up to 110, 111. And that would be a tremendous investment at 96. But what happens all of a sudden if Apple, like the rest of the market, breaks down below the neckline in a head and shoulders pattern, which it is? I mean, you got to be really careful with this one, John. Really, really careful. This is a bearish engulfing pattern from last month. Bearish engulfing pattern. Bearish engulfing pattern. Bearish engulfing pattern. Bearish engulfing pattern back here. This is 20 years of history. There wasn't a single time. Oh, wait, correction. There was only one time in 20 years. There's a bearish engulfing pattern. Only one time in 20 years that the bearish engulfing pattern did not result in lower prices. So you got to be careful. Be really careful. So, okay, just got a text from somebody there while I'm... Okay, folks, I certainly did not run out of content, and I certainly did not run out of energy and excitement, especially for all of you who are making money with us on the Trade Alert services. I'm only going to ask you to do one thing, just one thing. Number one, subscribe to the weekly market report if you have not done that yet. It's free. Just go to the Market Guys. Let me just make sure I'm giving you the right information. TheMarketGuys.com. Bill Shanley, my partner. I hope it's on the front page. Otherwise, I'm going to have to give you another link. But I'm pretty sure you can enroll. There it is. Just go. It says newsletter, although it's not a newsletter. All you have to do is put your email address and first name. You do not have to put your last name. You do not have to give me your social security number. You don't have to tell me where you live. That's so we can email you the alert. It's every single Friday. At the worst case, it'll come Saturday morning. You have the whole weekend to look it over. That's the only thing I'm asking you, that you do that and share the information with your friends and in particular your family members. We are on a mission to help save as many people as we can from the next big down move in the market. And I'm telling you, folks, like I said before, I'm in this market for 30-somewhat years, 35 years almost, 3.5 decades. I would not stake my reputation and put my neck on the line if I did not believe that that was the case. I will have egg on my face if it doesn't. I actually hope I'm wrong, but I don't think I'm wrong. I think we're going to see the next big market move is going to make 2008 look pale in comparison. And we're just trying to save people as we can to prevent people from suffering a catastrophic loss. So it's important you get the information out, share it, and then we'll meet again next month, just the way we have tonight in our open house. So again, I went a couple of minutes over. I hope it was worth it. Have a great rest of the week, and we'll talk to you soon. So long, folks.
This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.